Hello friends, a very warm welcome to my channel. In this video, we are going to analyze another company of the waste recycling sector. Earlier, we have analyzed a company called Antony Waste Handling Cell. And now we are going to analyze Gravita, which is another interesting company, which is mainly into lead recycling. And now it is diversifying into other materials as well. The purpose of making analysis videos is not to give you stock ideas. It is to teach you how to analyze a company, how to understand a sector, how to understand what are the risks and rewards in a sector, what to look for when you are studying a company. So there are a lot of things which you can learn from these videos. It's not that whatever videos I'm making, I'm going ahead and buying those stocks. But while I analyze different companies from different sectors, I become matured as an investor. I understand better all these sectors. I know what to look for while selecting a company in this sector. For example, in this video, when we are analyzing a company in the recycling sector, you will understand what to look for in a company which is into this business specifically. What are the risks in this business? So you try to catch those finer points when you listen to this video. If you're new to the channel, please do subscribe and hit the bell icon. And if you're not a part of our Telegram channel, do join today by searching my name on Telegram. Look at the top right corner of your screen. We discuss daily market analysis and a lot of interesting stuff on a Telegram channel. So let's begin the analysis of Gravita India. So this is the largest lead producer in India, and this company was started in 1992. So it's almost a 3-decade-year-old company, and more than 500 professionals work for this company. And the recycling process which the company follows is an environment-friendly process. So presently they have 4 recycling verticals. That means they are into 4 types of recycling materials. They have 12 recycling plants, more than 1400 touch points globally. So it's a global company having business in various countries of the globe. Out of the total revenue of the company, 42% is derived from value-added products. The significance of this we'll discuss going further. At present, the overall capacity of the company is about 2,15,000 metric tons, and they have aggressive plans to expand this capacity. They are operating at a 66% capacity utilization presently, and out of this total capacity, 34% of the manufacturing capacity is overseas. So they are not a company which are just manufacturing in India and supplying abroad. They have their own manufacturing plants outside India as well. They collect scrap worth more than 1.8 lakh ton every year. They are the first one in Asia to get the ILA certification, and they have a healthy order book of more than 60,000 metric tons. So by this you can get a fair idea of the company overall. Now let's talk about the management of the company. The founder and managing director of the company is Mr. Rajat Agarwal, who is having more than 24 years experience in this industry, and he has also been the former chairman of CII Rajasthan chapter. Now let's understand a brief journey of the company. They started in 1994 with a lead recycling plant in Jaipur. In 2001, they started their first overseas recycling plant in Sri Lanka, and recently they are facing some challenges with their Sri Lanka plant. Then their first recycling plant in Ghana was started in 2007. And in 2010, this company got listed on the stock exchanges. 2013, they started moving into value-added products for better margins. 2015, they diversified their business into plastic recycling also from lead recycling. And in 2016, they diversified further into the third material, which is aluminium recycling. 2019, they also expanded their operations in Africa. And in 2021, they started a new recycling unit at the Mundra port, which has a very high locational advantage. In 2022, recently, they also ventured into rubber recycling, which is their fourth material. Now, broadly, let's understand their business verticals first. They are into 3 verticals, which is the manufacturing, international trade of these materials which they manufacture, and also provide turnkey solutions for recycling plants. So when we talk about manufacturing, what they do in the manufacturing process, they procure scrap from various industries, they recycle it, they make a usable material out of it, and they sell it in India and abroad. So when we talk about this, they broadly are into 4 categories or 4 products, which is lead, aluminium, plastic, and they have also started rubber. Under these 4 categories, they manufacture the basic materials, and now they are also into value-added materials, further processed materials which have higher margins compared to the basic material which they manufacture. Other than these 4 verticals, in terms of manufacturing, the company is looking at further diversifying into newer materials like lithium ion and others. In their turnkey solutions business, what the company does is, let's say a battery manufacturing company wants to set up a lead acid battery recycling plant in-house. So this company can help them set up a complete project to recycle the entire lead acid battery in-house itself. So for this, they do the consultancy part, They also do the design, installation, and after installation they also take up the maintenance of that project. Up till now they have done more than 50 projects globally, and they are continuously doing R&D to further evolve their technologies. These are the different partners globally which Gravita works with. You can see very sound names like Schneider, Tata Batteries, Luminous, Exide. So there are several big brands which partner with Gravita to recycle their materials. When we talk about the revenue breakup, from India they get about 64% of the revenue and 36% of the revenue is from abroad. It is interesting to note that from the revenue which is getting from outside India, the margins are way higher. So although the revenue is just 36% from abroad, but the profit composition is almost 75% from the foreign countries, and they deploy only 30% of the capital for the outside business. So less capital employed, lower revenue, but higher margin business is from overseas clients. In terms of profit, overseas is 75% and India 25%. And in terms of value added products, presently 42% of the revenue comes from value added products, which are higher margin products compared to basic materials. In terms of volume, the major product which they are working on is lead, which constitutes 79% of their total volume, plastic 13.5% and aluminium 7.5%. When you see the EBITDA per ton, close to 15,676 is from lead, 16,851 is from aluminium. So aluminium is the highest in terms of EBITDA per ton, although the revenue share of aluminium is very less compared to lead, and plastic is way lower, close to about 10,000 rupees per metric ton. So this will give you a fair idea of the business which the company is working. Now let's talk about the industry trends in which this company operates. The government is taking several initiatives to protect the environment. They are making stringent laws. They are compelling the companies to follow these regulations, and several penalties are levied. So for various industries, this could be a tedious task of complying of these regulations. But for companies like Gravita, which are already into recycling of materials, this is a good opportunity, as the organized recycling of materials market will grow bigger. The government wants to track what materials are being produced in India. They want to force the company not to just throw out these materials and recycle these materials through organized players like Gravita. So this generates a lot of tailwinds for this industry. So the government's initiatives like the EPR guidelines, which are recently introduced for plastic materials, the vehicle scrappage policy, introduction of GST, all these will generate huge amount of business for companies like Gravita. Few other trends which you can observe in this industry is there are a lot of unorganized players in this industry, and the business is moving from the unorganized sector towards the organized sector. All these materials which are used in this industry are heavy materials which need good infrastructure. So as the logistics sector in India is improving, the efficiency improves, the ease improves, as well as the cost goes down, which is also beneficial for this industry. The OEMs are coming forward and tying up with different strategic players which will develop this partnership well, and companies like Gravita will get steady raw material from all these companies. As the domestic scrap recycling becomes more stricter, these companies need not import scrap from abroad. In India itself, they will get sufficient material, so they will save on the freight cost and generate better margins. Another peculiar thing which is to be observed in this industry is the companies try to open their recycling plants closer to the markets or closer to the factories where their customers are. This reduces the transport cost, and also the inventory maintenance also gets reduced, as whenever they get the material, they process it and try to sell it immediately. So the working capital cycle also goes down. So broadly, these are the trends you should observe when you invest in a recycling company like Gravita. When you talk about competition, Gravita has competition mainly from three categories of companies. One is the organized players in India, second is the unorganized players in India, and third is the overseas competitors, as this is a global company. So these are some of the names which Gravita competes in India. Most of them are unlisted, but this industry is very highly competitive, and that's why the margins in this industry are way lower than the other businesses. Although the company has a lot of competition, then what makes this company different from the others? Gravita provides turnkey recycling solutions which other recyclers generally don't provide. The management is very robust and experienced in this industry. They have almost 3 decades of experience in different materials and different geographies. The company is moving towards customized value-added products for their customers which generate higher margins. The company has a very robust hedging mechanism, and they try to maintain their margins stable. In this industry, as it is linked to commodity, the margins are very volatile. So Gravita is very strategic in their hedging strategy, so that they try to maintain their margins less volatile than the other competitors. There are several barriers to entry in this industry, as this industry requires a lot of regulatory approvals. It requires a lot of experience on how to recycle things. Sourcing in this industry is also very important, because you have to get the best quality raw material at the lowest price to make the better end product. So as Gravita is already expanded globally, they have procurement sources from across the globe, as well as supply sources to various customers across the globe, which is not easy for any other company to replicate in just a few years. The company already has long-lasting relations with several partners in the industry, where we have seen in the earlier slide, which is not easy for a new company to create in the initial years itself. So these are the competitive advantages which Gravita has as a company in this sector. Now let's talk about the growth and the vision of the company going forward. The company has created a Vision 2026. In this, what the company has planned is they will further diversify into other new verticals other than the 4 materials which they are doing, which are e-waste, lithium, because EV vehicles are coming, so they want to move aggressively into lithium now, rubber, copper and paper also. So as these verticals get diversified, the revenue will increase and the margins may also improve going forward. They are targeting a revenue growth of about 25% CAGR for the next 3 to 4 years, and in terms of profitability, they are targeting more than 35% CAGR, which is outstanding. They want to maintain their return ratios about 25%, and they want to shift the revenue share from 42% to up to 50% towards value added products, which will improve the margins. As of now, the company is largely dependent on the lead business, so they will further de-risk their business and reduce the dependency of lead business to less than 75% in the next 3 years. Now let's discuss a little more about the value added products which we are discussing in this presentation. So when you manufacture lead, pure lead is one form of material which the company manufactures, but rather than providing just pure lead, the company also further processes into these kind of materials like lead alloys, sheets, bricks, red lead, lead oxide. So these kind of materials are manufactured by further little processing of lead, which increases the value in the products, customizes it as per the customer's requirements and generates higher margin for the company. So over a period of time from FY17 until now, you observe that the share of value added products in the company's revenue has increased over a period of time. It has increased from about 28% to 42% now, and going further, the company targets it to increase to up to 50%. In terms of capacity expansion, the company is aggressively doing capex. The capacities in all the 3 materials have grown substantially in the last 4-5 years, and going further, the company will be more aggressive in adding capacities in their non-lead business, and overall they want to extend their capacity from about 2,15,000 odd metric tons presently to almost 425,000 metric tons, which is almost double in the next 3 years. These are some recent capex updates which the company is doing. They've started the aluminium recycling plant in Senegal, and they've also started a plastic recycling plant at Ghana. Over a period of time, you observe this, that the company has been regularly doing capex of about 50 to 100 crores, and that's how overall the company is growing going forward. Now, apart from all the good things which we have talked about, there will be risks involved in the business of this company as well as in the industry. So what could be the possible risk? There is high intense competition from both organized and unorganized players as well as international players. The company is highly dependent on the movement of the material prices, so the margins fluctuate as per that. Regulatory risk, as there are a lot of compliances by the different governments across the globe which the company has to cater to. If there are any macro factors or disturbances globally, the business of the company will be impacted. Supply chain management is very important, as this is an inventory led business where a lot of money is parked into inventory. If you see the company's asset turn, it is very high because the company's manufacturing plants require very low capex, but they generate very high revenue. So where the money goes in the company, it mainly goes into the working capital, which is inventory, debtors, etc. So the supply chain has to be robust to reduce the inventory levels in the company. So this is the business analysis of the company, and now let us move to the financial part. Comparing the last 5 years revenue, there is a steady growth in the revenue, and there is a jump of about 2,216 crores in FY22. We have to see whether this run rate is getting maintained in future or not, as the company claims to grow by 25% every year. In terms of EBITDA, the EBITDA fell to 62 crores in FY19. but went up to about 217 crores in FY22. So even if you see the revenue trend, there is a steady growth, but EBITDA is not steadily growing. As I told you that the margins in this business are very volatile, which impact the bottom line even if the top line grows. EBITDA margin is revolving somewhere around 8 to 10%, which is slightly on the lower side when compared to the other industries, but in this industry this is the normal base case margin. In terms of profit after tax, there was a huge jump of about 148 crores in FY22, which we have to see the sustainability going forward. The profit after tax margin is revolving somewhere around 4 to 6%, which is slightly on the lower side, but that is normal in this industry. Share capital has been the same, there's no change in the share capital. The reserves have been steadily growing as the company is continuously generating profits. In terms of debt, there is about 400 crores of debt on the balance sheet as on FY22, and debt equity ratio is 0.65, which is under control, but still the company has to maintain their working capital well, otherwise the debt will go on increasing, which we have to closely monitor in this company. In terms of trade payables, they are well in control and they are on the lower side itself. The fixed assets are steadily growing as the company is incurring regular capex. The inventory levels are rising. This is another factor which you have to closely monitor, that the inventory levels will at least have to stabilize at these levels. The inventory days have risen from about 2-3 months to almost 150 to 110 days, which is almost 4 months now. So the company has to work on bringing down the inventory days so that the working capital usage reduces. In terms of debtors, they have about 100 crores debtors on the balance sheet, and in terms of debtor days, they are reducing, which is a good sign of efficient working capital management. They have gone down to almost 18 days, which is good. You will not find much cash on the balance sheet as most of the cash is utilized in the working capital for the company. In terms of ROC, it has steadily improved to almost 31%. So the company is aiming to maintain this at above 25% going forward, which we can track. The operating cash flows are sometimes low. They have generated a negative operating cash flow in FY18 and very low operating cash flow in FY22. So this is another factor which we have to see whether they are continuously able to maintain positive operating cash flows or not. Free cash flows are sometimes going negative because of the capex which the company is doing, which is absolutely fine as the company is into the growth phase. The ROE is about 42%. It's a dividend paying company. The auditors are Mrs. Volker Chendoik and company. There are no major risky related party transactions in the company, and the executive directors draw about 4.5 crores of remuneration in the company, which is normal and well within the limits. In terms of shareholding, an interesting shareholder, Mr. Ashish Kacholia, is holding about 1.96% in the company. Promoters hold 73%, public 24%. FIIs, DIIs don't hold much. They hold just about 0.19 and 0.8%. Now let's talk about the valuations of the company, which is another critical part of the analysis. The market cap is close to 3,000 crores now. The price is about 424. It's a face value 2 share, not a face value 10 share. And presently the P is about 17, whereas the 5 years median P is 16. The price to book value is nearly 6 times and the historical median is about 2.8 times. So it's expensive in terms of price to book. The market cap to sale is trading somewhere around 1.18 times and the historic median is just about 0.5. So this also gives a overvaluation indicator. Now, in continuity of the valuation, let's also look at the chart. Now you can see that the chart is cyclical. The stock is making tops and consolidating for a very long time. So this is a kind of cyclical business, but the company is diversifying into various verticals to reduce this cyclicality. So recently you can see that the stock has given a very big run up. That's why the valuations have become pricey. So there are different ways to invest in these kind of companies. One way is you wait for the stock to fall and you buy at much lower levels where the risk reward is in your favor. The second way is you can gradually accumulate in small quantities because the chart is cyclical and you get an average out on your costing. And the third way is you can, if you feel that you want to ride the momentum and you're confident the company will continue this growth, you can put a trailing stop loss and you can keep riding the momentum even from the current levels. So it totally depends on what kind of investor you are. When you talk about the valuations purely in terms of fundamentals, presently the stock is overvalued compared to its historical averages, and it has also given a very sharp run up recently. So for risk reward to be in our favor as investors, we should wait for it to have some correction, consolidate, and then start gradually accumulating this stock. So this is about Gravita. I hope you like the unbiased analysis. Let's summarize by discussing the thesis and antithesis points. The management is well experienced in this industry for the last 3 decades. The sector has huge tailwinds as the government of India and various countries will support recycling of different materials to protect the environment. So the market size is huge across the globe. Companies giving high growth targets, and gradually if you accumulate this stock, the downside is a bit protected in these kind of companies compared to the new age companies which we are getting in the stock market these days. In terms of antithesis points, this is a cyclical business, so you should keep a track of the commodity prices in case you are invested in such companies. You have to also keep a close watch on the regulatory changes happening in India which will impact these industries. The global macro factors or unrest will impact this company as it has a global business. Generally, this sector which is related to the commodities are given lower valuations compared to others. So visually the valuations may appear cheaper, but these kind of sectors are generally given lower valuations only. In terms of competition, they have very high competition from organized and unorganized players, and the company is giving very high growth targets, but we have to see whether the government and the macroeconomic conditions are in their favor to really achieve these kind of capacity expansions and growth and margins in the next 3 years. So there is a risk of underperformance which you have to closely check in all the quarterly results going further. So this is about Gravita. I hope you like the analysis. If you like it, hit the like button and share with your friends. Subscribe to the channel if you are new to the channel, and don't forget to join our Telegram channel. If you want me to make videos on your favorite stocks, don't forget to comment the names in the comments below. Thank you for watching and have a wonderful day.